Trading covered stock options. Covered stock options involve holding a position in the underlying stock while simultaneously selling options on that stock. This strategy aims to generate income and manage risk. Covered stock options have evolved from basic stock trading, with roots tracing back to the early days of the options market. They gained popularity as investors sought ways to enhance returns and mitigate risk. In today's volatile markets, covered stock options provide a balanced approach, allowing investors to hedge positions and generate additional income. Here are 3 types of covered stock options. Covered calls. A covered call involves holding a long position in a stock and selling call options on that same stock. This strategy generates premium income but limits upside potential. Covered puts. In a covered put strategy, an investor sells put options while holding a corresponding short position in the stock. This approach can generate income and potentially acquire stocks at a desired price. Variations in strategies. Investors can employ various covered option strategies, such as rolling options, laddering, and using spreads to optimize returns and manage risk. Just a quick note to please hit the like button and subscribe to the channel. Also, visit us on the web at www.investmentees.com and use code BLOG to receive 25% on your next purchase. Components of covered stock options. Long position in stock. Owning the actual stock. Selling call options. Writing call options on the owned stock. Imagine an investor owns 100 shares of XYZ Corporation at $50 per share. The investor sells one call option contract, covering 100 shares, with a strike price of $55, expiring in 1 month. If XYZ's stock price remains below $55, the option will expire worthless, and the investor retains the premium. If it exceeds $55, the investor sells the shares at $55, realizing gains from the stock appreciation plus the premium. Several benefits of trading covered stock options. Income generation. One of the primary benefits is the potential to earn additional income through option premiums. Selling call options generates immediate cash, enhancing overall returns. Downside protection. While not completely immune to losses, covered calls offer some downside protection. The premium received from selling the call option offsets part of the potential decline in the stock's value. Enhanced returns. By collecting premiums consistently, investors can improve their annualized returns, especially in a flat or moderately bullish market. Portfolio diversification. Incorporating options into a portfolio allows for greater diversification and risk-adjusted returns. Here are some risks associated with trading covered stock options. Market risk. Stock prices can move unfavorably, impacting the profitability of the options strategy. Opportunity cost. Selling options can limit potential gains if the underlying stock price rises significantly. Transaction costs. Frequent trading of options can incur substantial transaction costs, reducing overall profitability. Limited upside potential. The main trade-off is the capped upside. If the stock price soars beyond the strike price, the investor's gains are limited to the strike price plus the premium received. Stock depreciation. If the stock price falls significantly, the premium provides limited protection, and the investor still faces a loss on the stock position. Early assignment risk. Option holders might exercise their options early, particularly when a dividend payment is imminent. This can lead to the sale of the stock sooner than anticipated. Choose stable, dividend-paying stocks with moderate volatility. Stocks with high volatility increase the risk of the stock being called away, whereas low volatility stocks might not provide substantial premiums. Strike prices should ideally be slightly above the current stock price to balance premium income and the potential for capital appreciation. Sell call options when the stock price is near a resistance level or after a significant rally. This maximizes the premium and reduces the likelihood of the stock being called away. Placing a covered call. Execute a covered call by selling call options on stocks you already own, generating premium income. Managing covered puts. Sell put options while holding a short position to generate income and potentially acquire stocks at a lower price. Adjusting positions. Regularly review and adjust your options positions to respond to market changes and optimize returns. Rolling covered calls. Rolling involves closing an existing covered call and opening a new one, either at a different strike price, expiration date, or both. This can help manage positions and extend the duration of the strategy. Collared strategy. A collar strategy involves owning the stock, selling a call option, and buying a put option. This provides downside protection at the cost of capping the upside potential, combining the benefits of covered calls and protective puts. Conclusion. Covered stock options offer a balanced approach to investing, combining income generation with risk management. By understanding the strategies, risks, and benefits, traders can enhance their portfolios and achieve their financial goals. Thank you for watching.